Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me at the market site in Times Square, we have Graham Day. He's the head of product over Innovator Capital Management. We're going to take a look at the Nasdaq 100 Power Buffer ETF that allows us to take advantage of the upside while having defined outcomes for the downside, ticker NOCT. It's great to have you back with us in studio, Graham.
Sure.
Let's talk about defined outcome ETFs in general. What are they designed to do?
Well, when we look at the space in terms of investors being able to access the market but have a built-in downside buffer, there really wasn't anything in the ETF space. There are a lot of products in the insurance world and maybe the bank world, but ETFs is kind of where people want to be. It's low cost, fee-based, transparent. And so the defined outcome ETFs allow investors to participate in an index like the Nasdaq 100 up to a cap, but have a known downside buffer. And we think, given where the markets are at, the increased volatility, this is an incredibly relevant product today.
Right, especially as you were saying before, the market activity that we've seen in September. And it seems as if October is going to have the same kind of trading pattern, but managing that downside risk is really key for these defined outcome ETFs.
Absolutely. I think after a 10-year bull run, investors aren't necessarily looking to have unhedged upside exposure. Are the markets really going to give us 13, 15% a year over the next 10 years? Probably not. And so if you're able to get a majority of that upside, but also have a known downside buffer of 15%, we think that's incredibly valuable for investors today.
Okay, let's dive behind the Innovator Nasdaq 100 Power Buffer ETF, again, ticker NOCT. Clearly that's based on the Nasdaq 100 index. Tell us more about the mechanics behind it.
Really very simple. At the end of the day, the Nasdaq 100 has been really the place to be over the last 10 years. On a price return basis, it's given investors over 16% a year. Like I was saying before, are they really going to give you 16% a year over the next 10 years? Maybe. And that's one of the beautiful thing about these ETFs is that they're going to give you the majority of the upside to the market. But really what people are more worried about today is what happens if the market's down 20? Is my strategy that hedges on the downside, is that actually going to give me a downside buffer? Well, with these ETFs, you know, if you buy it, you have a built-in 15% buffer. And so even if, as we look at this chart here, over the last 10 years, the Nasdaq has given us 16%. The upside cap on the October series that we just listed last week is 11%. And so if over the next year, the Nasdaq 100 appreciates another 16%, your worst case scenario is that you're going to capture about 70% of the upside. A lot of investors are incredibly happy with that. Yeah. More realistically, people are expecting the market to maybe give us 6, 8%. You will capture those gains one for one. And if there is a market correction, if the Nasdaq 100 drops, in this case 10%, you'd be flat. If the Nasdaq 100 drops 30%, you'd only lose 15%. And so I think that's where investors are really looking to say, I want to participate. I don't want to time the market. I don't want to have to, do I get in cash? Do I go in or out? With these ETFs, you don't have to. You have a built-in buffer, but you are also able to take advantage of upside appreciation.
How are you getting this built-in buffer? Are you using options?
Very simple options portfolio. At the beginning of the outcome period, we buy 7 options positions. We hold those for the entire outcome period. There's no active management involved with this. It's 100% passive, rules-based strategy.
All right. Thank you so much, Graham, for joining us at MarketSite.
Thanks, Jill.
And thanks for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.